Hello everyone, my name is John. I'm a partner of Skyward Community Nigeria, and in this video I'll be sharing with you information about the stock market and how you can leverage it to increase your wealth. I'll start by telling you that information is something that you should not take for granted, and this very information is one that can transform your finances. I know this because this same information has been very transformational in my own finances. And in this presentation, I will be taking you some three lessons. First of all, there's the wrong mindset about investing. So we will attempt to correct that by talking about investment. There is also a lot of knowledge gap in the space of shares and dividends, especially in areas of venture capital investing and how companies raise capital for their development, more especially how you can take advantage of this to make a whole lot of income for yourself. Then finally, I'll be telling you about a company, a venture capital, raising capital for its development and how you can be part of its development and leverage the opportunity and even share it with others. Now, my name is John Bose, like I mentioned earlier. I'm a freelance marketer. I am also a civil servant with the Ministry of Social Development and Gender Issues in my state. So I'm a social welfare officer. Added to this, I'm the founder of the LI 21 initiative. I am also a coach. I mentor people. I train people. I teach people how to save their money in dollar using their smartphone, how to leverage meaningful opportunities that can bring them passive income, just like the one I'm about to share with you. I've developed sales team in previous companies. I've generated sales in previous companies and even here in Skyward Community. I'm a 3-time Network Marketing Car Award winner, and of course, I show busy professionals how they can leverage opportunities for income. And I'll be taking you on the 3 lessons I mentioned earlier. But the content of this presentation is for educational purpose. If you have to make any kind of financial decision, check with your financial advisor. First lesson, what is an investment? Let's go.
An investment is an asset purchased with the expectation that it will generate income or appreciate over time. In finance, common investments include stocks, bonds, real estate, mutual funds, and to a lesser extent, commodities, annuities, and options. Many investments trade daily on the public market. Current events and company performance can cause a company's stock to rise or fall, and significant news can affect the entire stock market. Generally speaking, if a person follows safe investment practices, the longer they invest for, the greater the chance they will grow their wealth. Inversely, the shorter the period of investment, the higher the risk of that investment losing money. But with all investments, there is always some risk that the value of the asset will decline rather than increase. Despite the risk, wise investments are one of the best ways to grow your money. Let's say 2 brothers each inherit $100,000. Hubert does not invest his money, choosing instead to hold it in a checking account that earns no interest. Ivan, on the other hand, invests his money in some broadly diversified mutual funds. Every day, Ivan's investments change in value. Over 10 years, Ivan's average investment growth was about 7.2% per year, meaning his total investment grows to about $200,000. His brother Hubert, however, would still only have $100,000 in his savings account.
Well, so this was quite self-explanatory, but then we're just going to pull out some learning points from the video we just saw. Okay. Okay, my slide is refusing to switch. All right, so here we are. So key learning point number 1, especially important for the Nigerian market, is that an investment is an asset with an expectation, and The asset is whatever you're purchasing with your capital. The expectation is that that thing will appreciate in value over time. See, time is a key variable in the investment cycle. The longer you invest for, the greater the value of your asset. The shorter you invest for, the greater the chances your investment will lose money. So take note, any investment that promises you money within a short period of time is most likely a scheme that will lose you your capital. Every investment comes with associated risk. You should be aware of the risk. You should do your risk management. You should do due diligence, do your findings before you make any kind of investment. Even check with your financial advisor so that you can be aware of the risk and the potential reward of whatever kind of investment you decide to take. Now, despite those risks, making wise investment is one of the best ways to grow your money, and also diversifying your investment helps to reduce the overall risk of your investment portfolio. We'll be talking about one kind of investing, which is investing in shares, investing in stock market, and earning from either profit from the price appreciation of the shares you buy or from the dividends if they are dividends paying shares. Let's go.
A share is a single unit of ownership in a company or financial asset. It is essentially an exchangeable piece of value of a company or asset which can fluctuate up or down depending on several market factors. You can think of a share as a slice of the financial cake. Shares are also known as stocks. A company divides its value into shares as a means of raising capital. Imagine a company issued 1,000 shares. If 100 of those shares belong to you, then you own 10% of that company. People who own shares in a company are called shareholders or stockholders. Shareholders receive income from the shares they own on a routine basis. These are called dividend payments. A public company sells its shares on the stock exchange. Public company shares are open to the public, hence the name. A private company, on the other hand, sells its shares by private arrangement. If you want private company shares, then you must approach the company directly and persuade its shareholders to sell to you.
A dividend is a payment shareholders receive from a company's earnings. When a company is profitable, management can choose to reinvest profits to help grow the business or distribute those profits to shareholders in the form of dividends. Dividends come in several forms, but the most common is cash, which is deposited into shareholders' investment accounts. For example, if a company declares a 30-cent dividend and you own 100 shares, you'll receive $30. Typically, mature companies with strong cash flows are more likely to pay dividends. Many investors seek the income associated with dividends and often view them as a sign of strength and positive expectations for future earnings. Companies often pay dividends quarterly. However, some pay semi-annually or annually. Keep in mind, companies aren't obligated to pay a dividend and can reduce or stop paying it at any time. Some investors specifically seek out and invest in dividend-paying stocks. Dividend stocks can provide income and potentially enhance a portfolio's overall returns. Since 1926, the U.S. economy has undergone many bull and bear market cycles. However, the income return received from dividends has been relatively consistent during this time period. In addition to potentially higher yield, many investors look for consistent and growing dividends over time as an indication of company health and likelihood of paying future dividends. It's also important to remember that dividends aren't guaranteed. Companies that pay unusually high dividends may not be able to sustain them, and if dividends are cut, it might send the stock price tumbling. Despite these risks, dividend-paying stocks tend to provide income while still allowing for the potential of stock price appreciation.
Okay, so the key learning from this is that when you own dividend-paying stocks, you can benefit in two ways,
A share
and
is
one
a
of
single
them.
unit of ownership in a share
Forgive
is a
me for
single
that.
unit of ownership in a company. Unit of ownership in
Having a little bit of technical issues. All right, so here we go. Like I said, the dividend shares tend to give the holders both the opportunity to profit from increase in the price of the share unit on the stock exchange and also give them passive income from dividend payments. Whereas we have non-dividend shares which only allow the holders to profit from increase in the price of the share in the stock market. So if you buy shares that are dividend paying shares, you can get income from the company's profit, either on a routine basis, which can be annually, semi-annually, or quarterly. We have also types of shares or allotment units, as we call them. Now, we have private company shares, which are pre-IPO shares. We have public company shares, which include IPO shares, that's the initial public offering of the company shares in the stock market, and post-IPO shares, that's for when the company is mature, when they have been in the stock market for a period of time and they have had some history of making profits from sales, and the demand, the supply, the market factors concerned with that industry tend to affect the share price. So post IPO shares are for mature companies that you already have listed on the stock exchange market. We have the difference between pre-IPO shares and post IPO shares. I'm going to zoom this in a bit so that you can see closely. In terms of ownership, pre-IPO shares are owned by the founders, early investors, employees, and people who are privy into the opportunity to invest in that company when it is a venture capital project. This can even include high net worth individuals who the company reach out to support in their development. IPO shares, in terms of ownership, they are owned by investors who purchase shares during the initial public offering. And then post IPO shares are owned by the public investors who purchase shares on the secondary market. In terms of liquidity, pre-IPO shares are having a limited liquidity as they are not publicly traded. IPO shares, on the other hand, they have an increased liquidity as they are now publicly traded. While post-IPO shares have high liquidity because they are freely tradable on the secondary markets. In terms of price, generally, the pre-IPO shares are much cheaper because they are sold at a discount to the market value. Why is this the case? The company recognizes that you are investing in their startup period, their period of their early development period, and they understand that you are taking a risk in their development. So they give you what is called an investment risk premium. That is, they sell their shares at very low prices. I'm going to show you an example to illustrate this in details as we move down the slide. IPO shares are sold at the market value based on investors' demand during the IPO. So demand affects the price of the IPO shares. Even when they have stated that this is going to be the market value, demand can make that value go way up or come down. Post IPO shares are determined by supply and demand on the secondary market. So the market value of your post IPO shares is determined by demand and supply. We're going to be seeing this in the slide as we move along. In terms of regulation, pre-IPO shares have minimal regulation because they are not publicly traded, whereas IPO shares are subject to extensive regulatory requirements to ensure transparency and also protect investors. While post-IPO shares are continuously regulated to ensure compliance with reporting and disclosure requirements. Furthermore, we have, in terms of availability, pre-IPO shares are generally only available to employees, executives, and early investors. IPO shares are available to the general public during the IPO. Post-IPO shares are available to anyone who wishes to purchase them on the secondary market. In terms of risk, pre-IPO shares have high investment risk due to limited information and lack of liquidity. IPO shares have moderate investment risk as the market demand drives the initial valuation. Post-IPO shares have low investment risk as the market determines the fair value and the information is publicly available. In terms of the holding period, pre-IPO shares are subject to long holding period before they can be sold, because when you buy a company's pre-IPO shares, you have to wait till the shares are listed in the stock market before you can sell or freely trade them. IPO shares, on the other hand, there is no holding period because as you are investing in the initial public offering, you are coming in at the point of listing in the market and you can freely trade. However, it may be subject to a lockup period for company insiders. This is usually ranging from anywhere between 3 to 6 months. Now we have post-IPO shares, which has no holding period. And once you buy, you can freely trade the post-IPO shares. Now, in terms of hurdles, pre-IPO shares requires the accredited investor status and requires a significant investment. although there are platforms that make this hurdle a lot less difficult to scale, such as crowdfunding platforms that assist in the development of venture capital platforms that assist in the development of venture capital projects. So if you find and collaborate or partner with some of these platforms, it will be easier for you to scale through the hurdle, which is requiring significant investment or having the accredited investor status. IPO shares, on the other hand, they require only an investment in the IPO, but must be done on the primary market. Post IPO shares is open to anyone willing to invest. However, it may require higher transaction fees. Now that you know the difference between pre-IPO, IPO, and post IPO shares, we are going to continue with the presentation by looking in practical details at a real life example. So here we have a news from Punch, which was drawn out on the 26th of July 2020 of a very popular individual in Nigeria, who is the man Peter Gregory Obi. Now, he revealed in a conference or in a webinar, I'm going to move this so that you can see that really clearly, that how he revealed he lost out on an opportunity to invest in the pre-IPO shares of Zoom. You are going to be seeing that this was not the IPO or the post-IPO, but the pre-IPO, that is the before initial public offering period of Zoom Communication. Now, let me read through. Ex-Anambra State Governor Peter Obi revealed how he lost out on an opportunity to invest in the popular teleconferencing and online chat service app Zoom. He said this at a webinar held on Saturday. Obi said the investment was less than 30 cents, an opportunity he should have seized with both hands. He said, I was telling someone a few days ago how in 2015 I met people where I had gone to do a program in the US and they came out and told me about the Zoom business that just started. As of that time, it will cost you less than 30 cents to invest in Zoom if I wanted to do so. So it was 2015 and the price of Zoom shares were 30 cents per share. This is what you need to know. They also reached out to Peter Obi because Peter Obi is a high net worth individual. Like I mentioned, pre-IPO companies or venture capital companies can reach out to investors who they consider high net worth to support in their development. Now, look at the chart here, ladies and gentlemen, and if you focus on this point in the chart, let me move this over. If you focus on this point in the chart where I have my hand, okay, let me zoom that in again. Where I have my hand, you can see that on the 18th of April, Zoom Communication, you can see that that's Zoom Video Communication. They were listed and they announced their price on the public market. Their initial public offering was at $62 per share on the 18th of April 2019. So that represents a 20,666% price increase against the 30 cents price at 2015. So in just a period of about 4 years, the price had appreciated by 20,666%. Follow closely. Just the year after that, in 2020, you can see in 16th October 2020, the price per share of Zoom Communication reached an all-time high of $559 per share. Now, this means that the price, this was during the height of the COVID lockdown, the height of the pandemic, when Zoom application was very popular for online meetings, working from home became a thing and all of that. So this price now represents another 902% increase against the $62 with which they went into the IPO, with which they went public. And if you compare that with what they sold their shares for before IPO, which was 30 cents per share, that was a 186,233% increase against that pre-IPO price of 30 cents. Ladies and gentlemen, I put it to you, quite frankly, that there is no other investment category or investment in any other asset group that can appreciate value like this over the amount of time it takes, like pre-IPO investing. It doesn't come without its risk, but when it does give you reward, the rewards are massive. So ladies and gentlemen, if you find a good pre-IPO to invest in, you might just be setting yourself up for early retirement and financial freedom. So let us look at what this translates to in terms of numbers. potential profit analysis in terms of price appreciation. Now let us assume that Peter Obi only invested just 500,000 in Zoom as at 2015 when those shares were 30 cents per share. It's important to note that $1 as at that time was 198 naira. So 500,000 naira would be $2,525. Now if you buy shares at 30 cents per share, $2,525 will purchase 8,417 shares at that price. Now on the 16th of October, when the price of Zoom shares hit $559 per share, $1 also hit 380 naira per dollar. So let's multiply 8,417 shares by the new price of $559 per share to know how much the 8,417 shares will now be worth. So that is going to give us $4,705,103. So from $2,525 that those shares were worth as at 2015, they are now worth $4,705,103. Now, when we convert that amount to naira at the new dollar to naira exchange in 2020 of 380 naira per dollar, we would see that that amounts to 1,787,939 1,787,939,140 naira. So in 5 years, the man who invested 500,000 naira would have gotten 1,787,939,140 naira if they had invested that 500,000 in the pre-IPO shares of Zoom. Just from price appreciation alone, ladies and gentlemen, this does not even include the residual income from dividend payment. So let us look at the dividend that was declared. Okay, earnings per share for Zoom in the year 2023 was $4.64. So it therefore means that someone who holds 8,417 shares, that will be what, for EPS, that will be what, about $39,055. So what does this mean? It means that if you had these shares, they will be paying you a residual income of this amount in that year 2022 as at when they declared their EPS. Now, ladies and gentlemen, dividend payment does not mean that you are losing ownership of your shares, because if you have to sell your shares to profit from price appreciation, you are making them someone else's property. It's like you are selling a house and you no longer have a right to collect the rent on that house. But dividend payment is what you are paid because you are a shareholder in that company. So by earning your dividends, you are still going to continue earning them for life as long as the shares remain with you. And even say, for instance, you live your life, your time is done and you die, you can still pass it as an inheritance to your children and their children after them. So dividends are a stable way of receiving residual profit from the profits of multinational companies or whichever companies you happen to hold shares with. Now remember also that these companies that are multinational pay in dollar, and when we convert to naira, it is converted at the rate of current exchange of the naira to the dollar. Now, we know that startups or startup companies, or what we call venture capital companies, reach out to high net worth individuals, like how Zoom reached out to Peter Obi to finance in their development. Well, what are the other ways that startups raise capital for their development? We have that they also reach out to banks to obtain loans, and they also sell their shares through crowdfunding to members of the public. That's through private sales when they are still privately, when they are not yet listed. Another way they raise capital is during the initial public offering of the shares in the stock market and the subsequent sales in a process known as the initial public offering, or IPO. Now that we know all of this, what should you look out for when you are choosing a startup company or a venture capital company to support? The first thing you should look out for, ladies and gentlemen, is what problem is this company solving for the market? Because problems are where the money is. So ladies and gentlemen, if you find a company that is solving a person's problem, that company is only going to get a person's reward. If you find a company that is solving a community's problem, that company is going to get a community's reward. If you find a company that is solving a national problem, that company is going to get a national reward. And if you find a company that is solving a global problem, that company is going to get a global reward. So linked to the problem is the scale of the market. So who are the percentage of the market that have the problem this company is solving? Now, that also is linked to what I just said. If it's a person's problem, it's a person's reward, and a global problem, you get a global reward for it. The demand also affects the profitability of the company in terms of the demand frequency. So what is the sales turnover going to look like for that company? For their product or service, how often are their products or service going to be needed? Let me give you an example. If I were to purchase a smartphone, I will get a guarantee of maybe 12 months or 2 years that this smartphone is going to give me absolutely no issues within this time period, and I don't need to change it. It therefore means that if I am someone who is not very keen on changing his smartphone all the time, I can use one smartphone for 2 years. So if I am still very loyal to that smartphone brand, it therefore means that I'll be buying another phone maybe 2 years later or even longer, depending on how well I use my device. Now, the sales turnover per customer is once in maybe 6 months, once in 2 years, or once in a year. For products like smartphone, you don't buy them every day. So that is what I mean by sales turnover. But let us look at an industry like transportation. The fact that you have paid to go to maybe Lagos from Ibadan does not mean that you can still come back without paying your transportation. You have to pay. So a service like transportation has a high turnover because the customer requires it more than once a day. And for each time that they use it, they are going to have to pay for it. So in terms of sales turnover, investing in maybe transportation may give you higher turnover in sales than investing in smartphone production or investing in a company that produces smartphone, for example. Also, competitive advantage of the company in terms of what are its unique selling points, such as the proprietary technology, the strong brand recognition that helps it stand out in its industry, in its market. These are also things or factors that you should look out for. Other factors you should look out for include the management team, the growth plan, the company's financials in terms of revenue growth, profit margin, debt level, etc. Some of this information may not be readily available for a pre-IPO company, but some companies disclose their audit reports even when they are private. So depending on what company you're trying to invest with, try and see whatever information you can get your hands on, and then do your due diligence before you make any kind of financial investment. It's also very important to seek out the information of your financial advisor. Now, for the second part of the presentation, I'll be talking about Unitsky String Technology, which is a startup company that is doing something really amazing. And I don't want this presentation to span too long, so this is already going to about 30 minutes. I'm going to terminate this presentation here. But I urge you, watch the second part of the presentation to learn about Unitsky String Technology and the crowdfunding platform supporting it in its development, which is the social venture ecosystem of Skyward community, of which I happen to be a part. So ladies and gentlemen, I'll be seeing you in our next presentation. Thank you for sticking around with me.